When it comes to trading options, there's quite a few strategies that you can use to make a profit. Two of these that we're going to talk about here are straddles and strangles. Now, both of these involve the purchase of calls and puts, but there is a key difference between the two. So with a long straddle, we're going to use at-the-money options with the same strike price. With a strangle, the investor is going to look to trade options that are out of the money at different strike prices. So which one is the better strategy? Let's take a look at these. So a long straddle, all this is an option strategy. It involves buying both a call and a put on the same underlying asset with the same expiration date and the same strike price. When you put this trade on, you do it for a debit. So it's going to cost you to put it on. And if the profits in this underlying stock price rises above the upper break-even point or falls below the lower break-even point, you can make some money. The profit potential is unlimited to the upside. And if the stock price falls, remember, stocks can go to zero. So it doesn't matter which way that stock moves. But what we do need is it to make a big move in one of those directions. And this is great if you're expecting a large move pretty soon, but you're not too sure which way it's going to go. So our loss is capped to what it's going to cost us to put the long straddle on, plus the cost of the commissions. So let's use XOM as an example. And here it was trading at $114.13. So we buy a call and a put at the $114 strike price. And we're going to use the bid price for both buys just to keep this simple. The call was at $3.05. The put cost us $2.77, which is $5.82 to put the trade on. That's $582 per options contract. And also, this is the most that we can lose on this trade. And to make any money on this trade, we need the price of XOM to move past either break-even price. So to the upside, the break-even price is strike plus cost of the trade. So it's $119.82. On the downside, we need the price of XOM to break through $108.18. So if this price stays around the strike price of $114 through to expiration, both of these options expire worthless and it's a losing trade. If the price is above the strike at expiration, the put option expires worthless, and if the price is below, the call expires worthless. Now, most traders do not exercise their options and they're going to sell the long straddle long before expiration. So it's important that you have guidelines on when to take a profit. And some will use a percentage of their risk, or they'll just close the trade if a certain price point on the charts hit. Now, long strangles, our goal is the exact same. We want to profit from a big move in either direction. The difference is the strike prices we're going to use to set the trade up. So remember, a straddle uses the same strike price, but a strangle is going to use a strike price above and below the current stock price. So this means the strangle is set up out of the money and it is cheaper than the at-the-money straddles. So using XOM, remember it's trading around $114. We're going to look to buy two strikes out of the money. So a call option at a strike of $116. That's two strikes out of the money. So to keep that even, we're going to look to buy the $112 put option. Now to set this trade up, the call is going to cost us $2.09. The put is going to cost us $1.98. So $4.07 or $407 per contract. It's a lot cheaper than the straddle, but the problem is the price has to move a greater distance for us to make any money. Now to the upside, the price has to break. Again, it's a strike plus the cost of the trade, $120.07. On the downside, it's got to break through $107.93. And just like the straddle, our loss is limited to the amount it cost us to put the trade on, which is $407. Now, if the price stays within the range of the strangle or it's at a strike price, it's going to expire worthless if you hold it to expiration. If the price is above the call strike price, the put's going to expire worthless, and the flip side is also true. Now, as mentioned, options traders rarely exercise their options and are generally closed out to sell it back to the market. So which one's better? You know, better is always relative, but the main advantage of a strangle, it's cheaper to put on. Now, since you're using out-of-the-money options, the price you need to pay to buy the call and the puts is not as expensive as ATM options. Because they're cheaper, some traders can take a bigger position to profit from the moves. But that said, since the strike prices are further away from the current stock price, you need a bigger move to make money. Also, the longer it takes for that big move to happen, the time decay is going to eat into your position. So you need the price to move sooner and further using a strangle. The long straddles, they're closer to break-even prices, so we don't need that big of a move. Time decay is still an issue, But the closer strike prices, it's going to make that a little more forgiving. But the main drawback is the cost of them and the maximum risk. These are much higher than the strangle. So let's just summarize this here. What's the difference between a straddle and a strangle? A straddle involves buying a call and a put on the same asset with the same strike price and the same expiration date. Strangle buys a call and a put on the same asset, but with different strike prices, but of course the same expiration date. The advantage of a strangle over a long straddle, the main advantage, it's cheaper to put on. The disadvantage of the straddle over a long strangle, well, the main drawback is the cost. It's higher than a strangle. Since your max risk is the cost of the trade, the straddle has a larger risk profile than the strangle would. So what do you need the price to do for a strangle to be successful? You need the price to move sooner and further using that strangle, since those break-even prices are further away. It's a pretty basic strategy you can use, and I have a free ebook here, and it's going to talk about 2 markets that we like to options trade. Now, our one-day strategy is pretty simple. It's effective, and you can use it to make money in most market conditions. It's a free download. You can start looking at it today. The link is above. It's below. Take a look at it. See what you think about options trading. We'll talk to you soon.